What's up, everyone? Today's podcast is a deal analysis for a 12-unit value-add deal in Westminster, Colorado. So I have Marcus William here from Spearhead Commercial Capital to talk about how this deal came about. Now, what makes this interesting is that it is active. So it is a current deal in the higher interest rate environment, and it's the borrower is facing the same issues other investors are facing right now, which was when they buy a value-add deal, it's very hard to make cash flow and make the numbers work, which is often that DSCR ratio that commercial lenders are looking for. So we're going to unpack a lot here about how the deal came about and also how financing is now working on deals like this. So Marcus, William, always glad to have you guys in the studio.
Hey, thanks for having us back.
Thanks for having us.
So William, looking at you with this first question, I know you're running point on this deal.
Sure.
Set this up for us. Like, who's the borrower? What's the property like? Give us the rundown.
Yeah, so this is a repeat client of ours. This will be kind of the third deal we've done with him this year. He's very active in the multifamily market. And as it relates to the listeners of this podcast, he did come from kind of the single family value add fix and flip type of world. So he used to be a W-2 employee, and recently quit that job to do real estate full time. As a side hustle, they were, fix and flipping houses, and that kind of naturally progressed into true multifamily type of investment stuff. And they've gotten pretty comfortable with a few of the multifamily deals they've taken on as value add over the last handful of years, and so this is what they do, full time now. So. A client with probably about 10 properties, about half of those are still single families that they're holding and renting. And the other half are true value add projects with 2 or 3 actually in progress. Right
okay.
Now. Yeah.
And I mean, from what we were talking about before we hit record on the podcast was that this is, I call it a very classic value add play.
Sure.
What legacy owner, markets or rents well below market.
Yeah.
Any heavy lifting? What was the rough business plan on this property?
Yeah, so this was an off-market deal, which is why I think they probably got, a really reasonable purchase price for it. But the seller's an older gentleman who's owned this property, like you said, for decades. And, whether it's just kind of passive or maybe he has a bigger portfolio where he just didn't, pay attention as much. But, the market rents had taken off and he just hadn't raised rents on his tenants to, constantly stay at where market rents are. So with this deal, I mean, the rents on each one of these units is probably anywhere from 60 to 70% of what market rents will allow. Granted, there's some value add interior remodel rehab to be doing to get to those market rents.
I mean, anything major or just a typical?
No, typical cosmetic,
go from flooring. A 1970s to modern.
Yeah, exactly.
Finishes.
They'll do some updating or facelift to the exterior as well. But really from an interior perspective, it's your typical carpet paint.
Okay.
Countertops, cabinets.
Do you, I know we don't have the spreadsheet in front of us, but what was the rough purchase price? What's the rough construction cost? Do you just kind of give our listeners some context on there?
Yeah, they're right around $6,000 to $7,000 per unit on their rehab budget. Purchase price here, I think penciled out right around 3.2.
Okay.
And so what we ended up here was 75% loan to cost. So the lender is doing the acquisition price at 75%. They're also including about 75% of the total rehab budget in the loan. So you can see the loan structure is a 7-year term, get a 30-year amortization when it does amortize, but the first 12 months of the loan are interest only to help them through that rehab, lift.
Okay. Now, the part I really want to dive into, because I've seen this issue come up and I've talked to a bunch of people, is that buying a property, even though they're probably getting that, it sounds like, relatively good deal, rents are still below market. We know where interest rates are at. Having it cash flow or having that DSCR coverage, I know is very, very, very tough. But you put together a good loan program for this.
Yeah.
So talk about the challenge and all that, please.
Sure. Yeah. The challenge is that when your rents are at 60 to 70% of where market is, and the seller's trying to obviously get top dollar when they're selling it, is that, with high interest rates, peak type of market pricing for the sale of the asset, your debt service coverage is going to be low. So typically the way to shore that up is you got to bring more cash down. So most of the stuff that we see in Denver metro area for multifamily is really only penciling it somewhere around 60% loan to value, just because the rents aren't high enough. The NOI is not high enough to, chase down where rates have gone these days. So the interesting part about this one was knowing that this was a value add. He was looking for max leverage to include, tenant improvement dollars with the loan, without having to raise equity and give part of the project away. They were looking for max leverage, and that's where we came up with a lender who can do, has a credit policy that allows 1-to-1 debt service coverage, or DSCR, on the front end, so long as the improvements made to the property and an appraisal NOI upon stabilization can support a 1.25 debt service coverage upon stabilization. So that's the big key to this. And, they will be obviously doing some rehab to the property to increase the property value. And therefore that's the model to get some of these tenants and these units up to market rents.
From the investor standpoint, when they're out there, getting deals like this and talking to you for a loan, is this a common product investors can find out there, or is this pretty unique to this property? Or perhaps since this is not his first property, but he has a track record, how common is this loan available for people, or is it very specific to certain situations?
Yeah, I mean, I'd say his experience plays a critical part in that, right? You can't just buy your first multifamily deal with a value add and expect to know how to do it well.
Or probably get terms like this.
Yeah, exactly. That's the part of the puzzle for the lender. But I would say this is pretty uncommon policy out there. I mean, we have a couple lenders who can kind of dip below the 1.2 or 1.25 debt service coverage ratio that most lenders require. If there's a value add path to increasing rents and getting NOI up, they can be kind of more pro forma looking, but this is a pretty unique credit policy for sure. We have a couple of deals going through this lender with that program, just given where rates are, where NOI and debt service coverage pencil out on deals that are, metro area.
Okay.
Yeah.
So I want to kind of walk through the timeline on here. So 12 unit, I'm assuming they'll be turning a unit or two at a time here. How long do they project it for them to turn all the units and then get them up to market rent?
Yeah. So 12 months interest only isn't just arbitrary. I mean, that's really what they project to be able to turn all units. They have no plans to empty this thing out and start, turning all units. So they're waiting for leases to turn off. They're going to go in, rehab that specific unit, bring it to market, get it up to market rents. Knowing that people sign 12-month leases, there aren't really any brand new leases in here. But by the time they, close on this deal, which is really in the next couple of weeks, they will have, people at least, 1 or 2 months into their leases. So 12 months should be enough time to reno each and every unit. They should be having this thing fully stabilized at market rents by the time the interest only period runs out.
And so since this is, it's a 7-year term loan with a year IO, it's not, I wouldn't call this a bridge loan since this is a 7-year term on here. So are they planning on refinancing out? Do you think after it's up to market and stabilized, or is just the type of loan they can hold for a few years and then, hey, if rates dip, they'll refinance then?
Yeah. This is, the prepay was important here because of that exact reason, right? Once they get market rents, obviously property value is different. The NOI is different. They might seek cash out from this upon stabilization to go buy another property too. So the prepayment penalty was front of mind. This lender happens to have no prepayment penalty on this loan. So depending on where rates are, after 12 months of stabilized NOI hits the books, we could potentially take this out with agency or, other kind of non-recourse financing that would maximize their cash out position to spend into the next project, or just, reimburse their balance sheet for their portion of the CapEx in.
As the game plan now, it's just, what the market's doing, just, hey, follow this game plan, and then 12 months, 15 months, once it's up and running, see what the situation's like, and hold or refinance or pull cash out? Just depends what happens in 12 months?
Yeah, if the market's more favorable, certainly this lender would look to adjust the rate and keep it on the books if it's performing. If it's not, we can go back to market for them. But that's what the beauty of the 7-year term too is they don't have to do anything for the next handful of years.
So I like this structure a lot. Like, I didn't really I read the brief before we got on here, but now I'm really connecting the dots. But this gives them like some really good optionality, but also they just stay and hold, stay and maintain this loan, like they're in a very good spot. So like that seems like obviously you structured it this way for a reason, but it seemed like it was set up very well.
Right. And by comparison purposes, if we had to stick to like a 125 debt service cover on this deal, they would have had to bring something like 40% down, and it would not have included any of the rehab dollars that they needed to put in. So that's kind of the fun part of the 1-to-1 go-in debt service is it keeps cash on their balance sheet. And allows them to kind of maximize the project from
Are there any
perspective.
like reserve requirements for this? Because I know when COVID a couple of years ago, reserves became a lot more popular with structures like this, or interest rates rising, or lenders going back to reserve requirements or anything.
That would be the typical way you would shore up a deal like this without in-place cash flow. Would be, hey, if you're able to come up with 12 months of debt service that you could land with the lender and say, look, here's where the next 12 months of payments can come from if this deal doesn't pencil out the way we want. That's how you would shore it up with a lender who's underwriting on the front end at 1.25.
Okay.
Debt service cover would be bring some extra deposits. They might be able to push leverage there just based on the cash that you have in the institution. For this one, no, there actually is no reserve requirement on
really
for the 1-to-1. Now, if it was sub 1-to-1, they would have to post enough cash to make up the difference between 1-to-1 and sub 1-to-1. Okay. So we're really getting into the weeds, but it's like, let's say this thing penciled at 0.8% or 0.8 times debt service cover. They have to bring enough cash to patch up that 0.8 to get it to 1-to-1 on the front end under it.
Not as a down payment, but just in the reserve account to make up the difference.
In addition to downstroke.
Okay.
Yeah. Mm-hmm.
But they will have on deposit, they'll have the TI budget, I imagine.
Yeah, they're putting the their portion of the tenant improvement dollars at the institution. That's a requirement. They will have an operating account with this lender so that the payments can auto debit. But outside of that, it's pretty lackadaisical structure, I would say.
Man, that's probably a lot less capital than 12 months worth of reserves, I would imagine, too.
Yep, exactly.
All right. So looking at, the market, this type of loan structure, and, lots of people wanting to continue to do like multifamily value add, what's any differences, any other difference in the landscape out here that investors should be aware of as looking at deals? Like, I think we've all had our rules of thumb for underwriting over the last handful of years. A lot of those rules of thumbs are changing now. Like, what broad level guidance would you give to investors out there while they're looking at deals and obviously thinking about the debt piece?
Yeah, we see a lot more kind of syndication activity, I would say, just because people are having to raise extra money to bring the bigger down payments to make a deal go. Because rates are up here, purchase prices are still up here. The purchase prices haven't kind of come back down to reality. So unless someone has a 1031 money from spinning out of something, there's usually not a giant chunk of money just sitting there waiting to be, no one likes doing 50% loan to value deals unless that's very, strategic around just not liking high leverage.
So you're seeing more basically people syndicating a deal versus just taking it down themselves now with a higher equity requirement.
Yeah, but you have to just give up your own returns to raise more equity for the down payment is what kind of we're seeing because deals don't pencil as well.
Interesting. I never thought about that, but I'm not surprised to hear that. Yeah. Okay. Anything else in terms of that and what you're seeing activity going on, or either from the investor side or trends on the lender side?
Yeah, I mean, trends on the lender side are constantly reoccurring, just given where interest rates are. I mean, you see the 4.75% rate here. I mean, that was kind of secured at least 45 days ago. And they will hold on to a rate for 60 days for someone without a formal rate lock. But if for whatever reason this thing gets pushed, I'm sure that rate will adjust to where markets are. But that's an ongoing conversation, right? Is the rates just change daily now, and it's kind of unfortunate. So just pay attention to what your timelines are. And we do see, and you can jump in, Marcus, but I've seen a couple of sellers try to pencil in an extra 30-day extension because when they sell a property, they're probably going to 1031 into something else, and they want more time to go see what's out there. And 90-day rate holds, pretty challenging, given the volatility in the market. So
I'm sure buyers, they don't want the extension because then they're just
buyers don't, because no one can
Compromises
protect
their
their
loan.
rate. Yeah, absolutely. So there's a good amount of give and take and negotiation around contract timelines currently.
Yeah, but let's say this same lender today is pricing at 5.4 for a similar type term, let's say. That's what people need to be recognizing in their stress tests of their pro formas, right? Something is 45 days. That's quick in real estate. We all know that. That's one hiccup in a deal. That's you miss out on a deal and now you have to go find another one. That's a crazy change in interest rate environment. So I hope that folks are, when they're stress testing their deals, that they're starting probably with an interest rate that starts with a 6. Make sure your deal can work around there. And then, of course, you can try to negotiate a better rate in the capital markets when you're out there exploring deals. But you have to be realistic.
So you're saying take market and add a little bit right now.
Of course. Yeah.
That's a great point. I mean, I think when we're underwriting your sizing deals, we're using a 6% interest rate. That may not be what you get as a client, but we want to make sure that, hey, if we're, during this 30-day period of you're looking at a property, getting it under contract, finding a lender who will do it, we just kind of have to build that in now. Just because of where interest rates are. And we have put out term sheets that are, 7 to 10 year rates that do start with a 6 handle now. It's kind of the reality of things.
Yeah, so that's the reality, and the trends are going to keep going that way for a little bit.
Yeah. And I would say prepayment penalties are important because there is some speculation that maybe, rates come back down this time next year or whatever, if, recession kind of drags out or however you want to look at it. But, be cognizant of that. We have people looking at, 3 and 5 year money now versus like 7 to 10 because they feel like they could refi if rates come back down.
Yep.
So, unless you're ultra comfortable, I would just say, there's a balance between locking in a long-term fixed rate and being able to refinance that thing if rates do come back.
So you're seeing a lot more people just do shorter terms?
Yeah, because if there is a prepay associated with it, it's usually less. It's obviously less on a 5-year deal than it is a 7. Yeah. No,
I mean, that makes complete sense. It's always just fascinating how everything just starts changing this year. All right. So in terms of I'm curious, this investor, obviously he's out there wheeling and dealing. He's out there finding active deals. Gino, has his strategy changed, or is he still going after that and just adjusting on the debt side like everyone else?
His strategy is shifting because of that. I mean, you buy enough deals in the same year, you sort of run out of cash from a balance sheet perspective or from what you think is a comfortable amount of cash. So there's opportunities that he's talked about with us recently that would involve syndication and them giving up some equity to continue to pursue deals. But yeah, they're active. They're looking for stuff that has return. And, the max leverage game is really hard right now because nothing pencils. So unless you're going to chase a new, secondary or tertiary market where you might still find like a 6 or 7 cap on the go in from a value add perspective. It's all just going to kind of look this way for now. But yeah, I think he's looking at different markets, trying to find something that makes sense and potentially bringing in, some other investors to assist with the equity side of things.
Awesome. Yeah. Well, as always, guys, I enjoy this. I mean, it's always great to talk to you about deals. And, I say this every time we get together, but we love working with you guys. We as agents like it. Our clients like it. And I think you guys are great at taking people's situations, their goals, their property, their asset type, running that through your filter, playing matchmaker, and getting them on the same page and putting together some deals. So love working with you guys, and thank you for coming on the podcast.
Thanks, Chris.
Yeah, thanks again for having us.
See you guys soon.
Yeah,
All right.
you bet.